Grandfather yourself to reinvest tax-free. In this episode, we are going to address the question, do I have to pay back the loans on my indexed universal life insurance policy? This is episode 13 out of 21 in a series titled Secrets to a Tax-Free Retirement. I would recommend you invest a few hours, watch the entire series, and empower yourself to accumulate an extra $1 million or more that will generate $100,000 a year of tax-free income as long as you live. So my name's Doug Andrew, and I've been a financial strategist, retirement planning specialist for more than 45 years. My favorite vehicle for people, especially planning for retirement so they don't outlive their money and they eliminate the dangers of taxes, inflation, and market volatility, is what is called a max-funded, tax-advantaged, indexed universal life insurance policy. It's what I affectionately call the laser fund because it meets the tests for a prudent investment: liquidity, safety, predictable rates of return, and it's tax-free to boot. So in this episode, I am explaining how you can grandfather yourself. Now, what does grandfather mean? It means that if they change tax laws in the future, you're grandfathered. You don't have to abide by new tax laws because the government, and I can't guarantee this, but there's always been a precedent set that whenever they pass new tax law, so it does not adversely affect something you established under previous tax law, you're grandfathered. So if you've watched previous episodes in this series, I've had indexed universal life insurance policies and regular universal life policies that I've owned before TEFRA and DEFRA and TAMRA. I haven't had to abide by those. I was grandfathered. So one of the neat ways to access money out of an insurance contract is by borrowing it. It's the smart way to do it. In the previous two episodes, I talked about you can borrow conservatively and use a zero-wash loan because loan proceeds are not deemed earned, passive, or portfolio income. They're tax-free. There's nowhere on a tax return to put it. The IRS knows you receive it. The insurance company reports it, but it says Section 72E, 7702. It's tax-free. It's not even worth auditing because it's never been taxed. And so the secret is when you borrow out the money, you could borrow out income for 20 or 30 years in retirement, and you don't have to pay tax on that because it is not taxable income. Now, sometimes people ask, well, now, I don't have to pay that back? The short answer is no. The loan balance is sort of phantom. So let's use an example. Let's say you have $1 million accumulated in your indexed universal life insurance policy at retirement. And it doesn't matter if you have $1 million, 100,000, 10 million, you can extrapolate from my numbers here. So every million that you have accumulated, if it's earning, let's say 10% net, which is what I've earned for the last 25 years on the average, that means $1 million would generate 100,000 a year of interest income. If you take it out the smart way with a loan, you borrow out 100,000 and your million keeps compounding to $1.1 million, $1.2 million, $1.3 million and compounding. And so this cash value compounds and stays ahead of the loan balance. This loan balance, I call it phantom because it's not due and payable during your lifetime. When you ultimately die, this is washed away with what? This increased compounding account. This minus this asset that's growing minus this liability equals the same amount of money you would have had you pulled it out the dumb way and paid taxes of maybe 33% on that 100,000 every year. So do it the smart way. But here's how you grandfather yourself. You ready? So using that example, let's say that I retire at age 60. Now, I've had many clients who retired in their 30s. You don't have to wait till you're 59 and a half, or you have to start pulling it out at age 70 and a half or at age 72 like you do out of an IRA or 401k. But let's just say at age 60, 65, every million you have earning 10%, you pull out 100 grand. So let's use that example. So I withdraw 100,000, I can do that up to my basis. But what I do is I borrow it from day one. So I borrow out 100,000 and it's tax-free. Now, why would I borrow it when the IRS says I can recover my basis by just withdrawing it? I don't have to pay tax until I've gotten all my money back that I invested in it, because of the grandfathering provision, which means that if I pull out 100,000 a year and I call it a loan, let's do it for 10 years. 100 grand for 10 years is $1 million. Now, this account over here is worth $2 million, and I have a loan balance of $1 million. Now, these have interest associated with them, but $2 million minus $1 million equals the same million that I would have had I pulled it out the dumb way and paid tax. But if I pull out 100 grand a year for another 10 years, let's say for a total of 20. 20 years times 100 grand is 2 million. Now, I have this phantom loan balance of 2 million over here. But see, this is now worth 3 million or more, okay? Now, what value is that? Well, you wouldn't believe how many times when people later in life have a windfall of money. They didn't even see it coming, maybe an inheritance. Maybe they finally sell a large piece of real estate or downsize. They're sick and tired of taking out the trash and fixing toilets and evicting tenants on these rental properties. And all of a sudden they decide to sell and they have a windfall. Maybe they struck it rich on an investment or their business or whatever. This happens more often than you would believe. So let's say they have $2 million and they come and they say, oh, you know what, Congress, doggone them, they have passed laws now that you cannot open a new insurance contract under the same tax benefits that you did before. I'd say, no problem, you're grandfathered. Well, I already maximum funded my previous one. I go, I know. You put in the maximum you were allowed. You could reinvest $2 million back into that grandfathered contract. How? I maximum funded it. Because you borrowed instead of withdrawing your money, you borrowed it out. So you have this phantom loan. It's not due and payable during your lifetime. It doesn't mean you can't pay it back. Why would you want to? Because if you pay back the loan, the $2 million and the interest that accumulated on that $2 million that was offset by the compound interest over here, you're allowed to put that $2 million in one fell swoop because the insurance company said, oh, new money, new investment. Your $2 million hits the ground running, so to speak. If you're earning 10%, you put in $2 million by paying off a loan. It's just new money back in the insurance policy. And that $2 million at 10% allows you to start taking out 200 grand a year tax-free instantly the moment you put it in there. You don't have to wait 5 years under TAMRA. You don't have to comply with TEFRA, DEFRA, and TAMRA. You have a grandfathered contract to reinvest money up to the amount that you borrowed out because the IRS says, oh, you were just repaying a loan, even though it's not due and payable in your lifetime. You were repaying a loan. The insurance company goes, that's a reinvestment of new money. It's tax-free, and they've already jumped through the TEFRA, DEFRA, and TAMRA hoops. You hit the ground running. This single strategy here has helped many, many people who came up with new money down the road in retirement for a grandfathered account to be able to put it to work again tax-free without having to wait 5 years to qualify under those IRS tax rules that relate to a brand new insurance contract, or what I call a bucket. So that concept is a very little known strategy that many financial advisors and even insurance agents are not aware of. Would you like to grandfather yourself to reinvest in the future money back into a tax-free contract? Learn how you can do that. Now, I implore you to watch the other videos in this series, Secrets to a Tax-Free Retirement. It's a free course. And also, if you want to learn more, my 11th book is titled The Laser Fund. I authored it with my two sons, Emran and Aaron. We have actually an 18-hour masterclass on this that you can go through. But reading the book, there's 300 pages containing charts, graphs, explanations of all of this in great detail. And you can study it and reread and so forth. But I want to give you a copy of this free I'll buy the book. You go to laserfund.com to claim your free copy. You just pay $5.95 shipping and handling, and I'll fire a copy out for you.